So today we're talking about interest rates and house prices and how one will affect the other, and we'll end with my prediction what prices will do over the next 12 months. But before we get into that, in case you don't know who the hell I am, I'm William Gale, and I've spent since 2013 building a UK-wide home buying company, British Home Buyers, a nationwide estate agency, British Home Sellers, and a 7-figure property portfolio. So really this channel is all about me sharing my experiences with you. I want to start with interest rates. Since 2022, we have seen interest rates significantly increase, not just here in the UK, but in reality all over the world. And everyone, not just here in the UK, but across the US and Europe, have expected a significant drop in house prices on the back of that. And that just hasn't happened. So for context, I want to explain why that is, what it means to you, and what will happen from here. Will house prices rise dramatically, fall, or just stay about the same? And my goal from this is we'll end this chat with you having a clear understanding of how this prediction is made up, rather than just taking my word for whatever I've predicted. So let's start with how COVID affected house prices. Now, if you cast your mind back at the start of the COVID pandemic, there was panic that house prices would collapse, that the economy more broadly would collapse. And of course, we all know that never happened. But at the time, we had the country going into lockdown, if you remember, at the end of March, and the property market was essentially closed over April and May. So at that time, I essentially had to close my nationwide estate agency, British Home Sellers, leaving myself and a few others manning the phones with everyone else furloughed. And we were just at that time speaking to concerned customers, buyers, sellers, to be supportive. Then when the market reopened in June 2020, interest rates by that point had already dropped to 0.1%, and the market surged like crazy. We were seeing a 20% increase in sales within my agency. All this before the stamp duty holiday even existed. But despite this, the government, economists producing these house price forecasts were all concerned that house prices would crash anyway. So me and my team are sat there selling 20% more property, and on the other hand, everyone's panicking about house prices dropping. So why did the experts get it wrong? Now, I believe it's because people oversimplify the connection between the country's economic performance and house prices. If the economy shrinks, surely house prices should shrink as well. When in reality, when you operate in a market where there is an ever-growing disbalance between supply and demand, that has a greater push and influence over house price growth than the economy itself. Property is essentially a madly popular product that everyone aspires to have. Anyway, despite the fact that the housing market opened strong, the government introduced the stamp duty holiday anyway, the following month in July, and that lasted a whole year. And that completely overheated the market. In my view, the stamp duty holiday was a complete mistake and it just wasn't needed. So why did house prices not crash at that stage? I guess on one hand, you could say it was due to the stamp duty holiday and low interest rates. Of course, those things helped, but in reality, I know the property market opened strongly that first month, and that in reality, all the stamp duty holiday did was overheat an already strong property market. In reality, it actually goes beyond this, because in reality, the stamp duty holiday was a tiny, tiny part of the huge amount of money the government pumped into the system at that time. The total support was £169 billion, which is the equivalent of about £2,500 per adult and child being spent. The stamp duty holiday, on the other hand, cost the government £2.4 billion, so the equivalent of £35 per person. It equates to 0.014% of all government support in the pandemic. So in reality, the stamp duty holiday was a tidy piece of a far more dramatic increase in the volume of money the government was printing and pumping into the economy. And they ultimately got that formula wrong, because we can see the amount of wealth that accumulated within the average household over that whole entire time. It's skyrocketed. So this graph shows the household saving ratio, which basically shows you the percentage of household resources that are saved each month. So you can see it was always hovering about 5%. So on average, a household would save 5% of its income. What happened over COVID, over lockdowns, is this peaked almost 25%. So in reality, the government support was really designed to stop households going into the negative, when in reality, the average household saw their wealth, their savings grow faster than they'd ever seen before, purely because, as you know, we couldn't go out, couldn't do anything, couldn't spend money on the things we usually would spend money on. So the unintended consequence of the government over supplying support is the average household built huge amounts of wealth. Ultimately, this translated in a huge increase in consumer demand for not just property, but everything. At the exact same time, supply of everything was lower due to the effects of lockdown. There were less homes being built, for instance, at that time. Factories had been shut all over the world and so on. So under these conditions, with the beauty of hindsight, house prices were always going to skyrocket. Inflation was always going to skyrocket because people had more money to pay higher prices. This problem was always man-made. But then interest rates skyrocketed to attempt to stabilise things. So look, COVID created a novel situation that the governments and economists completely misjudged and mispredicted the actual economic impacts of. The downside is the correction to this came in the form of successive interest rate increases, starting almost 3 years ago now, from 0.1% all the way up to 5.25%. So a 52.5 time increase. So this completely changed, if you think, the direction of things at this stage. All of a sudden, governments and economists building price forecasts worked on this assumption that, well, surely if interest rates go up, asset prices, house prices should go down. And look, of course, simplistically, all things remaining equal, that makes complete sense. If mortgage rates go up, you can't afford to pay as much, and so demand goes down. And I'm sure we've all seen that happen or directly experienced that. On the flip side, those with high savings benefit from better saving interest rates, and so are less likely to spend cash they have on assets like property. So high interest rates can actually help lock in cash in savings for that reason, rather than it being spent on assets. But of course, as we know, what ultimately happened is house prices sort of dropped a little and then increased a little and dropped a little and sort of stayed relatively flat the entire time, more recently starting to increase again. Ultimately, overall house prices are still higher and are still growing. They've just slowed down their trajectory of growth. So of course now the question turns to, well, why did house prices not crash again? We had COVID. Everyone predicted a house price crash. It didn't happen. We have skyrocketing interest rates. Everyone predicted a house price crash would happen. It didn't happen. So why have house prices not fallen? Ultimately because of a number of mechanisms in place to avoid house price crashes to begin with. Mortgage products are usually fixed for 2, 3, 5 years. Mortgage lenders stress test borrowers at close to 9% interest rates before granting a mortgage. You can prolong your mortgage term now from 10 years to 20 years to 30 years, even 40 years plus, to lower your monthly payments, to spread the burden. So the way to imagine the property market in a way is like one of those valves that lets water flow one way, but makes it very hard for water to flow back on itself. It's easy for house prices to increase, for water to flow one way, because if there's water, people keep buying and buying and that water keeps flowing. But it's hard for house prices to drop because all of those mechanisms in place to avoid property owners being in a position they need to sell or need to end up getting repossessed are there. So that water never flows back. And a lot of those mechanisms were actually put in place after the last financial crash in 07, 08. I really think if you imagine the flow of property transactions like that water valve, where water can easily flow one direction, representing properties being bought, but it's actually very hard for water to flow back on itself in the form of forced property sales. Seeing the property market like that essentially for me makes the property market all of a sudden make a lot more sense in my head. It makes a lot more sense why prices haven't dropped and seem to only go one way. So what's going to happen moving forward in my view? Well, now we're seeing inflation drop, most recently actually just below the 2% target. In reality, we're going to see interest rates cautiously begin to continue dropping over the coming 24 months. That's not a guess. We've been told that will happen by the Bank of England. The massive inflation we saw wasn't unexplained. As I've gone through, it was caused by a huge amount of cash being printed and gifted by the government over COVID that just exploded household wealth, which obviously dramatically increased the average person's spending power, boosting prices and inflation. You'll start to see interest rates normalize, not to the 0.5% or 0.75%, but more likely towards 3 to 4%. And I say 3 to 4%, but in reality to whatever the US decides to do, because in reality, we're always following their lead on interest rates anyway. The dollar has so much power over the global economy. The reason I believe interest rates will have to keep dropping is because of the new situation we're about to find ourselves in and how that will affect house prices moving forward. So what is the future of house prices? As the dust settles at this point, the new situation we find ourselves in is that average households are worse off than pre-COVID. So an entirely different situation to where we were before. Households have burnt through that wealth that's accumulated over COVID. And in reality, real earnings, that red line you can see on the graph, hasn't caught up to where it was pre-COVID. So the average person doesn't have the same spending power as before. And so in reality, lowering interest rates is gonna really become a necessity to ensure we actually keep to the 2% inflation target, that we don't go into deflation. And I know that seems mad, but house price inflation is no way affects inflation targets. So all lowering interest rates will do is increase the affordability of the already existing demand for property, boosting property prices. Those increases in property prices in no way will affect inflation targets, and so interest rates won't be adjusted to counteract the house price increases, if that makes sense. So frankly, I just can't see how house prices aren't going to continue doing anything but go up over the next 24 months. Watch this back in a year or two to see if I'm right. Comment if you've got any other points of view, and I'll see you in the next video up here.